This is part 5 in our Receivables and Accounting for Uncollectibles series, in which we're going to be talking about reporting of receivables on the balance sheet, and we'll also look at a couple of ratios. So first, let's start with how do we report receivables on the balance sheet. So let's look at an example. Concentra Medical Center included the following items in its financial statements. They had allowance for doubtful accounts of $120, cash of $1,150, accounts receivable $2,580, accounts payable $1,020, notes payable $3,280, service revenue $14,400, other assets $350, and cost of services sold and other expenses of $12,800. And we're going to show two ways Concentra can report receivables on its classified balance sheet. Remember what a classified balance sheet is. It's when we classify our assets and our liabilities as either current or long-term. So the first way we can show these receivables on the balance sheet is, again, we classify them as current assets, and we'll start with our total account receivables of $2,580. From that, we have to subtract the contra asset account to accounts receivable, which is the allowance account, or the allowance for doubtful accounts of $120. That will give us our net accounts receivable of $2,460. There is a second way that current assets can be reported on the classified balance sheet. That is, we can call it accounts receivable net of allowance for uncollectible. You also could see this accounts receivable net, and then you would just assume that's net of allowance for uncollectibles. And notice it's the same amount on both, $2,460. Now the second method here, the corporation would be required to enclose in the notes to the financial statements, which follow the financial statements in the annual report. They would need to report there the total accounts receivable and the amount in the allowance account. Now let's look at two more ratios. Now these, like our other ratios, can be used to help us evaluate a company. The acid test ratio, you also may see this called the quick ratio, will show how the company, if the company has the ability to pay its current liabilities if they come due immediately. And when we say immediately, that means within 30 days. So how liquid are they? The formula for the acid test or quick ratio, the numerator is cash plus short-term investments plus net current receivables. Remember again, the formula for net current receivables is your accounts receivable less your allowance account gives you your net. You add all three of those and that's your numerator. And you divide all of that by the total current liabilities. Now, if you compare the acid test ratio with the current ratio, they're very similar. But the current ratio shows the company's ability to pay their debt within the next year. The acid test ratio is can they pay their current liabilities if they were to come due immediately within 30 days. So slightly different there. Days sales in receivables. This is how many days on average it takes to collect your account receivables. And the formula to calculate this is your average net account receivables divided by 1 day's sales. Or, if we break that down into smaller pieces, it's your beginning net account receivables plus your ending net account receivables, those two added together, divide that by 2, and then all of that is your numerator, and then divide all of that by net sales divided by 365 days. And that will tell us how many days it takes to collect accounts receivables. Of course, the smaller this number, the better.